Now we will take a moment to introduce you to our speaker. Our speaker today will be Stephen Bland. Stephen is the Education Director for the West Michigan chapter of the Association of Government Accountants and is a principal at Raymond, where he serves as the firm's Public Sector QC Director. Stephen is a CPA and a certified government financial manager with over 26 years of experience in the governmental and nonprofit arena. He is also a member of the AICPA's Government Audit Quality Center Executive Committee. Stephen, you may begin the presentation.
Thank you very much, and welcome everybody to what is actually our 11th consecutive annual GAAP update. Very excited to dive in and talk about what's new in the world of government accounting. As we always do during this annual webcast, we're going to start by talking about which standards maybe were not issued recently, but became effective recently. The ones that hopefully you've already implemented, and if you haven't, that you're ready to do so very soon. We'll also talk about what the GASB has been up to in the last year, what new standards have been issued. I can tell you, sneak preview, it's actually been a relatively quiet year over the last 12 months. And then we're going to talk about those standards that are on the books, but not yet effective, that are coming soon, and then finally give you a little sneak preview of what's coming ahead with future standards. So what standards became effective in the last year? Honestly, not a lot that has become effective in the last year. We had Standard 89, which is super simple. In fact, most people early implemented it without even realizing they were, because it's a very short standard that basically says, stop doing something complicated and make your life easier. So most people either didn't have that complicated thing or immediately hopped on the bandwagon when the GASB gave us the opportunity. So while technically it did become effective during 2021, you can see the asterisk that's by there was really because that was extended along with all the other GASB standards during the pandemic. I'm going to guess that not many organizations actually saw a change. The other standard that was adopted and became effective in 2021 was actually in the unusual situation of being on two of my lists. It's going to be listed here as a standard that was effective in 2021, and you're going to see it in a couple slides as a standard that was issued in 2021. Very unusual for the GASB to have such a quick turnaround, but this was also a very easy standard to implement, and so it became effective almost immediately, and it's a very simple one for everyone to grab. The real meat of our presentation is going to be 2022, and we have 5 standards, several of which are fairly significant, that will become effective this year. The GASB tends to kind of go in little spurts, and 2021 was a blessedly easy year on the governmental GAAP front. We had plenty of things going on with federal grants and pandemic-related matters that I don't think anyone complained. The GASB was a little light on implementation last year, but we're going to pay for it a bit in 2022 with all these new standards. So the 800-pound gorilla that has been kind of in front of us for a few years now and has finally come to its extended implementation deadline is GASB 87 on leases. Because we have covered that in the past in great detail, the last couple times around, we've kind of glossed over some of the higher level details. Now that we're back right on the implementation, the cusp of needing to put this one into effect, we'll dive back in a little more deeply and try to make sure everyone's comfortable with what needs to happen, because this is it. Everybody who's got fiscal years ending on or before, basically, or on or after, I should say, June 30, 2022, it's going to be implementation for you. And obviously, early implementation is always an option. A few other little ones, conduit debt, omnibus, those are not going to be major issues, as is replacement of interbank offered rates. But GASB 97 on component unit criteria and 457 plans was a much needed correction to try to solve some issues that kind of percolated up through GASB 84 and fiduciary activities. Speaking of GASB 84, this is the first year in a while that we've not talked about that, because implementation should still be behind us. But if you have any lingering questions on that, make sure you check out our page of archived webinars where you can find more information on that oldie but goodie. Looking ahead then into 2023, we have 2 fairly meaty standards that are coming: the public-private and public-public partnerships and availability payment arrangements. We're just going to call those PPPs and APAs because that's a mouthful. That standard's going to be implemented next summer, and so we're going to have to keep an eye on that. The good news is most governments won't find themselves running into this on an everyday transaction sort of basis, but when it comes, it's going to be a fairly significant one. And then GASB 96 is basically GASB 87, leases, but for software. A lot of governments have leased software, cloud-based software especially, but not limited to that. And they wonder, how do I handle this contractual obligation to pay for software in the future? What does that look like? So we'll talk about that near the end of the presentation. I told you the list of what the GASB implemented in 2021 was pretty short, basically just GASB 98, that little standard that became effective in the same year it was released. And this is really just a titling issue. We have renamed what used to be called the Comprehensive Annual Financial Report to a new name, the Annual Comprehensive Financial Report, and a new acronym, the ACFR, ACFR. We'll talk about that briefly when we get there. And then most years, the GASB has an implementation update. The 2021 implementation update came out and has a variety of small technical updates with effective dates ranging from this year to a few years out, although early implementation is always a good idea when it comes to the implementation guidance, because frankly, it's there to try and help us implement things that we're already working on. All right, enough of our overview. Let's go ahead and get into the details. I told you that the big standard that everyone's going to be implementing over the next year, GASB 87 with leases. So I was actually recently attending a training where we were highlighting the difference between the FASB model for leases, and that also has gone through a major overhaul recently, that's followed by for-profit and nonprofit organizations, and the GASB model for leases, the new one for GASB 87. If you go far enough back in history, the GASB and the FASB were aligned. They both followed the same GAAP, and it was the GAAP that many of us learned when we were studying for the CPA exam, all the different tests to determine whether something is a capital lease or an operating lease and the separate accounting for them. And it was a big piece of our college experience, learning the differences of those different types of leases. Well, the GASB's moved away from that, and the FASB's moved away from it in a slightly different path, but we're going to focus on the GASB's approach, which unfortunately continues to be different than the FASB. So if you are comfortable and familiar with that for-profit and non-for-profit model, I'm afraid this one's just a little different for the governments. The GASB has defined a lease as a financing. Now that's a really important thing because over on the FASB side, a financing lease or a finance lease is a whole different type of animal from an operating lease, and they separate things that we're just not going to see in the public sector. So what does the GASB mean? It's a financing. Well, it all comes down to the GASB's fundamental conceptual definition of a liability. You'll remember that the GASB issued a concept statement a number of years ago where they gave their definition of what constitutes an asset and a liability and a deferred inflow of resources and all the other different pieces that go into government financial statements. But when they were talking about liabilities, they said a liability is an obligation, a present obligation that a government has to sacrifice resources that the government has little or no discretion to avoid. So the question is, have our governments entered into some kind of transaction, some kind of relationship, some kind of contractual obligation that they have to sacrifice resources and they have little or no discretion to avoid it? So a lease, they've argued, is a way of financing the right to use somebody else's asset. You're financing it in that you've agreed to make payments in the future. You have created an obligation to sacrifice resources. And depending on whether there is little or no discretion to avoid that will drive the accounting for what the leases look like. The GASB's approach is a single model. So there are just leases. There aren't operating leases and capital leases. There's just leases. But they did take a good chunk of what we currently think of as leases and say they're not leases anymore, which is just a little confusing, but hopefully we'll address that in just a few slides. The super simple, oversimplified version of what GASB 87 looks like is we value the lease liability and the lease asset as the net present value of future payments over the lease term, and we just record offsetting assets and liabilities. It sounds simple, and when you look at it from that perspective, it really is. But as we get into some of the nuances, you'll see there's a bit more to it. The effective date of this standard was extended as part of GASB 95, pushing everything back during the pandemic. And so fiscal years ending on or after June 15, 2022, basically this summer, is when we have to do implementation. Early implementation is obviously still an option for everybody. So the formal definition is a contract. Now, they don't get hung up over the term or the legal form. Remember, in accounting, we care much more about economic substance than legal form. So a contract or agreement or whatever format it takes that conveys the control of the right to use another entity's non-financial asset as specified in the contract for a period of time in an exchange or exchange-like transaction. Now, there are a lot of words to unpack there. So let's look at each of these sections separately. I mentioned a contract. That is more of a, we're going to say, a contractual relationship, an obligation, an understanding, an agreement. We're not going to get worried about the legal form of that. And then we're going to talk about the control of the right to use another entity's asset. I've got a slide, very next one, that's going to talk about exactly what the control of the right to use means. But basically, you have custody of the asset. You have the ability to decide how the asset gets used. You're leasing the asset. And it's exactly what any of us would think of. If you're leasing a car, it's your car to drive around. If you're leasing a piece of equipment, it's your equipment to use. If you're leasing a building, it's your building to set up office space in or operations, however you're going to do it. The asset being leased needs to be non-financial. The GASB was not trying to write weird standards where you could lease an investment or something. So non-financial just means something tangible, something other than a financial asset like cash or investments. There has to be over a period of time, and you'll see why in a minute. But basically, the way we value leases is we say, how much are you going to pay out over a fixed period of time? And that period of time has to exist. If that period of time is 0, then the liability is 0, and there's nothing to record. If that period of time is 3 years, then we're looking at what's going to be paid during 3 years. If it's 20 years, we're looking at that 20-year window. So that period of time becomes important. And the last piece that's in this definition that's very important is that these transactions have to be either exchange or exchange-like transactions. You'll remember that in government, the GASB has given us a whole category of revenue called non-exchange revenue. It's where something is given up without something of equal or comparable value being exchanged for it. And we see that in the area of taxes and grants and donations and any number of things where there's not a reciprocal transaction. There are leases like that. Well, I should say things that call themselves leases, where a government leases a building for $1 a year or a 100-year lease for $100. Things that it's very clearly not an exchange transaction where both parties are giving up and receiving something of comparable value. So if we're dealing with those kinds of non-exchange transactions, GASB 87 doesn't apply. This is really for things that are legitimately being leased at more or less fair value. So I promised a slide that explains what the control of the right to use looks like. And basically, it's the right to obtain the present service capacity from, meaning this asset exists for a reason. I get to get the benefit from it, whatever that asset's benefit is. If it's a car, I get to drive it around. If it's a piece of equipment, I get to use it for what that equipment's for. If it's land, I get to decide how that land is put to use. So the present service capacity means I get to use the asset. And I get the right to determine the nature and manner of use of the asset. So maybe I'm leasing this and I'm letting someone else use it. I'm still controlling that. I'm still making the decisions. That would be control of the right to use an asset. We already said a non-financial asset is basically anything that's not financial in nature. So GASB 72 talked about investments and the like. Really what we're looking at for non-financial assets are tangible things: land, building, vehicles, equipment, the stuff that we normally would lease. Remember that this includes any contract, any agreement that doesn't explicitly have the L word in it, doesn't have to say it's a lease to be a lease, as long as it meets the definition. And that definition, again, is back here: the control of the right to use a non-financial asset and an exchange transaction over a period of time. So if you meet that definition, then it's a lease. Now, we do exclude contracts for providing services. Providing services are different. Now, there are times when you have a single contract that's, we're going to lease the asset and we're going to provide service for the asset, maybe a photocopier, where we've leased the copier and the company is also going to provide service and maintenance. You'll see in a later slide that where possible, we try to bifurcate that and treat that like two separate arrangements. But we're not, then we'll just say, fine, if you can't separate it, it's all one lease, we'll stick it together. Now, the GASB has a whole litany of things they said are not leases. Anything intangible, that wasn't a lease. Biological assets, inventory, SCAs, a whole list of things. But the one item that I asterisked here that might be important to remember is computer software. The GASB wasn't quite ready to jump in on the computer software bandwagon when this standard came out. So they said, you know what, we're just going to scope it out for now. We'll come back to it later. And that's really what GASB 96 is on software subscription-based IT arrangements. We'll talk about that later on in the presentation today. Other things that are not considered leases are short-term transactions. Basically, a lease has to occur over a period of time, and that period of time needs to be greater than a year. If it's less than a year, we're not going to call it a lease. It's considered a short-term lease, and it just gets treated like a regular period cost. Now, this last one is the part that's really going to trip some people up, and that is a contract that automatically transfers ownership. If you remember the old lease standards, a transfer of ownership at the end of a lease contract was actually one of the hallmarks that made something a lease. It's the reason a lot of governments currently have assets and liabilities on their books today. Some sort of an arrangement where they're leasing a piece of equipment or a building for a period of time, and at the end of that, it's theirs. We said, well, that because it's ultimately going to become theirs, it's essentially capital in nature. We're going to book the asset, we're going to book the liability and move on. And the GASB said, we like everything about that except the lease word. We don't want to call it a lease. We said, yeah, if you're going to transfer ownership at the end, then we're going to argue that really is a financed purchase and you should book an asset, but it's not a leased asset. It's not the control of the right to use someone else's asset. It's just the asset itself. You're basically buying it. And the liability isn't a lease liability. It's a obligation to pay for the asset that you're ultimately buying. It's just a financed purchase obligation. Think of it like an installment purchase agreement. So those, which are probably already on your books, are going to stay on your books. They're just not going to be called leases anymore. And new leases that you enter into, or things that maybe are styled as leases that say there's an automatic transfer of ownership, no longer a lease, just treat them the way you used to treat them before, and we're not going to call them leases anymore, even though lease might be in the name of the agreement. It'd be great if we could get away from that in the future, but if we can't, we can't. The GASB cares more about the economic substance. So to recap, short-term leases, maximum term, less than 12 months, then you just recognize expense if you're a lessee or revenue if you're a lessor in real time. No asset to book, no liability to book. This is just a short-term thing. Now, if you have a rolling month-to-month lease or a year-to-year lease, something that doesn't have a stated term, it's just you can lease and here's the amount every month, and we haven't agreed in advance to any non-cancelable period, then the question is, what is the notice period? So if there's like, you can cancel at any time, you just have to give 3 months notice. Well, then it's a 3-month lease. Even though you might stay in that lease for 10 years, the fact that you could cancel at any time, we're focusing on the cancelable, the non-cancelable portion. The 3-month notice period is your lease term. Now, if you said you can cancel anytime, we just need 3 years written notice, well, then it's really a 3-year lease. And that's very unusual, right? A notice period would usually be much less than a year, maybe 6 months notice, maybe 3 months notice, maybe 30 days notice. If so, then you're looking at a very short-term period, and that's your lease term, meaning it's a short-term lease. If ownership automatically transfers at the end, then you're going to call it a financed purchase. You're not going to call it a lease at that point. And this is different. We're going to talk later about what to do when you have the option to buy the asset at the end of the lease and you think you probably will exercise it. That's different than a contract that contractually transfers ownership, that says if you keep making your payments, and you're contractually obligated to make your payments, so I hope you're going to, if you keep making your payments at the end, you own it, then the GASB says you bought it. But if at the end of all this, you have the chance to buy it, that's a different scenario. So we have to look very carefully here. Does this contract actually transfer ownership, or does it give you the option to purchase at the end? Here's a sample contract where it says at the end of the term, the lessee shall acquire legal title to the vehicles and terminate this lease. Basically, that tells you in writing, that's not a lease, that's a financed purchase, and it should be recorded as such. So that language is going to be very important. If you have the option to buy it at the end and think you probably will, we're going to treat it like a lease. If it's automatically yours, whether there's no option to exercise, it just transfers ownership, that's not a lease, and that's something instead you're going to treat as a finance purchase. I hope that distinction helps, and we'll talk about it a little more as we move forward. But first, CPE prompt number 1. As I'm watching our poll results come in real time, we are holding right at 50-50. About half of you are in the office, about half of you are at home, which of course is the office these days for a good many of us. Looks like final numbers came in right at that middle point. We are right on the edge. A few of you said somewhere else, so I hope it's someplace sunny, and I hope that you're only giving this half your attention while you enjoy wherever it is you are. All right, let's continue on. So remember, Under the old rules, we had operating leases and capital leases. That's gone. Under the new rules, we have short-term leases that just get expensed in real time. We have financed purchases, which gets recorded as a capital asset and long-term debt, exactly how we're doing it today. And then the focus of today's presentation is everything that falls into the category of a lease. And we are still going to book an asset, and we're still going to book a liability, but they're a little different than we do with financed purchases. So let's talk about what that looks like. If it meets the definition of lease, an actual lease that we're really going to follow the lease standard for, then what we're going to do is value the lease at the present value of all the payments that are expected to be made over the lease term. Now, I've highlighted the lease term because that becomes critically important in this kind of scenario. If we're going to book the liability based on how much gets paid over the term of the lease, I really need to know what the term of the lease is so that I can adequately make that calculation. And you'll notice that the accounting here is basically mirrored depending on whether you're the lessee or the lessor. So governments that are leasing equipment out to others and serving as a lessor are going to use this math to value how big their receivable should be. How much will I collect over time? Well, it's the present value of all the payments that I'm going to collect or receive during the lease term. Lessees, those who are leasing assets from somebody else, are going to use this math to determine how much they're going to pay out during that term and what the net present value of that is. Now, before you get too worried about the whole net present value thing, just think of it like any other debt. Think of it like a mortgage. If you go out and buy a house, all of your payments are going to be a mix of principal and interest. If you issue bonds, it's going to be the payments are going to be a mix of principal and interest. We know during a lease, in most cases, this varies, but in most cases, we have a fixed payment each period for the lease. Maybe there's a scheduled increase that depends on the lease, but usually a fixed payment of some kind. That fixed payment, the GASB is telling us, includes both a component of principal and interest. And the net present value is just our way of getting to the answer of what's the principal portion of that transaction so that we can deal with that and then move on for the next piece, which would be principal versus interest. So that's all net present value means. We're going to look at all the payments. We're going to figure out how much is principal, how much is interest, and we're going to move on. The lease term then is the period that we're going to measure that during. And the way we're going to do that is we're going to look at the period where the lessee, that is the organization that is leasing the item or equipment, has a non-cancelable right to use the underlying asset. The GASB is all about that definition of a liability, remember. And that definition said this is a present obligation to sacrifice resources that the government has little or no discretion to avoid. So what do you have no discretion to avoid? Well, the non-cancelable portion of a lease. You can't cancel it, then you can't avoid it. You have to pay it. Now, in addition to that non-cancelable period, leases may have a number of other periods that are available for extension or possibility for termination, and the GASB gives us some rules on that. But before we dive into those specific rules, let me just tell you, it all comes down to over what period do you expect the lease to actually operate? Do you expect the lease to operate over 5 years? That's probably the answer that we're ultimately going to get to for the lease term. But let's look at the math and how we get there. They say, take the non-cancelable period, the part that is just fixed by contract. There's no getting out of it, no ifs, ands, ors, or buts. This is what the contract non-cancelable part is. Add to that any time period where you have the option to extend and say, not only do I have the option to extend, I think I'm probably going to. All right, so if you have the option to extend and think you're probably going to, then that should be added to the non-cancelable. I have to do it for at least the non-cancelable portion, but I think I'll probably also carry it a little further, throw those in. What if it is not non-cancelable? It's technically cancelable. I'm in a lease, I have a contract, I have the right to get out. Is that a period, a liability that I have no discretion or little or no discretion to avoid? I mean, it says right in it that it is cancelable. I could get out if I wanted. Do I have to book a liability for that? Well, here the GASB says, again, look at the likelihood of using that period. Technically, you could get out during this year, but do you expect to? If it's reasonably certain that even though you could cancel, you probably won't, include that period too. And then in those unusual situations where both parties have the option to get out at any time, or if it takes both of them agreeing to extend, we call that a cancelable period. That's too much math to try and figure out. So the rolling month-to-month lease is a great example. It doesn't count. We don't include that in the period. Now, a few of you will say, you know what, all of my contracts technically say I could get out at any time. They say every year, if funding isn't adopted through the budget, then I'm not obligated to stay in this lease. And technically that's true. But this is back to the economic substance over legal form. The governments who put fiscal funding or cancellation clauses in their agreements are saying legally, I can't commit today to pay this bill in the future, but practically I'm totally going to. The GASB has said, this is just boilerplate language that you're required to stick into your contracts, but you fully intend not to cancel because frankly, that would be economic suicide. Who would ever want to do business with you if they can't trust you to keep your word and meet your obligations? In that case, ignore these and move forward. We understand that it's part and parcel to the government world for some people, but it shouldn't impact your lease term. So what is the lease term? Well, at the start of a lease, and I know this is a little more complicated at transition when we're first adopting the standard, but going forward for new leases, at the start of a lease, consider all the factors that might come into play and ask yourself, what's the likelihood that I will exercise these options? So look at economic incentives and disincentives and past practice and how important the asset is, and just say, I know I have to keep it for the non-cancelable portion. Are there periods when I have the right to extend? Will I likely do so? When there's periods that I have the right to cancel, am I likely to do so? And once you have made this decision, once you've said, I've looked at it, I've figured out what my lease term is going to be, you basically leave that alone. Now, there are a few limited circumstances where we would go back and reassess. We thought we were not going to exercise an option, and it turns out we do. So we said we'll have the option. It's a 10-year lease. After 10 years, I have the option to extend. There's no way I'm going to do that. I'm not going to want this asset that long. I'm going to get something new before then. 10 years rolls around, and all of a sudden you do actually extend. Well, you'll have to do some kind of an adjustment at that point because the asset is fully off your books. And so that would be a new transaction, something you're going to have to deal with. Or maybe you're 7 years through your 10-year contract and you've already signed something to extend an additional 5 years. Now's the time to find out. And you're glad you know, then you can do a reassessment and make adjustments. But honestly, other than that, or something happening in a contract that triggers an event that requires you to do something, to extend or terminate, we pretty much pick our best guess and leave it alone. If our best guess changes down the line, we're not reassessing every year. We wait until something actually has happened, or we've actually exercised an option. We've actually been contractually obligated to do something. All right, that was a lot of slides. That was a lot of theory. Let's try and make this a little more practical. It's a two-step process. Ultimately, in many cases, it's a look at it and tell me what feels right process. But these are the specific steps that get us to the right answer. So figure out what periods you can't get out of. It's absolutely non-cancelable, non-negotiable. That's what the contract says. And then look at the optional periods. So here's an example. We have a contract that lets a government control the right to use a bus for 3 years. They're going to lease a bus for 3 years. And after 2 years, you can terminate. And after 3 years, you can extend for 2 more. So the question is, what's the period of this lease? It's technically a 3-year lease, but I can get out after 2. So you could argue it's a 2-year lease, but I can actually extend for an additional 2. So you could argue it's a 5-year lease. So what is it? Is it a 2-year, 3-year, 5-year? Is it some mix of all of them? Well, if you follow the steps, here's what you get. After 2 years, we can terminate. That means technically the non-cancelable period is only 2 years. 2 years in, you have the option to terminate. For the first 2 years, no option to terminate. So at a minimum, we know 2 years is our answer. It might go up from there. Well, good. I only gave you 3 options, 2, 3, and 5, and the 2 is on the list. So good. The 2 years is our non-cancelable period. Now let's look at our options. After 3 years, we have the option to extend. Let's say for the sake of argument, we expect to. We think we're not going to terminate, even though we could terminate after 2 years. And in fact, we think we are going to extend when the option to extend comes along. So in that scenario, what we would look to is we'd say the non-cancelable period is years 1 and 2. Year 3 is technically cancelable, but I'm not going to cancel. And so knowing I'm not going to cancel, instead, I say, yeah, I'm going to include that in the lease term. And then years 4 and 5 are an option to extend and saying, I fully expect to do so, I include those in there. So we went through a lot of steps to come back to what our gut would have told us from the beginning. How long do you think this lease is going to last? 5 years. 5 years is the answer. It's the answer because it's the sum of years 1 and 2 plus year 3 plus years 4 and 5, or you could just say it's a 5-year lease from the beginning. Hopefully that makes sense. Let's take our second CPE prompt. We are checking in on your favorite social media platform, watching the real-time results come in, and Facebook is ahead. LinkedIn is coming in tied for second with other. Not sure what else is on the list. Maybe others, your way of saying social. What now? I don't want to do that. That's possible. Facebook looks like it's the winner, with about half of you coming in on the side of Facebook. Very good. Moving on. So how do we recognize, how do we measure what shows up on our books? So if you are a lessee, that is you're leasing equipment or something from somebody else, then what you're going to do is book a liability and an asset. The liability is called a lease liability. It's very similar to what we would have historically thought of as the long-term debt that we've used for leases, but we're actually going to call it a lease liability. It's going to have its own little section in the financial statements and the notes, etc. And we have to have an asset. That asset historically would have been capital assets, but the GASB said you don't actually own the asset. You own the intangible right to use that asset. So that's what we're going to record is an intangible right to use asset. But nobody wants to write out the words intangible right to use asset. So we're just going to call it a lease asset. A lease asset, a lease liability. They equal, they match, life is easy. It's just grossing up the balance sheet. There's a little more to it, but so far we're off to a good start. If you are a lessor, you're leasing things off to other people, you're going to use that math that we just described, and we're going to come up with a lease receivable. That's how much you're going to collect over time. Now, the GASB said you can't take all of the revenue from that lease up front. If you're going to lease it over 10 years, you ought to recognize the revenue over 10 years. And so what do we do when we want to book want to recognize book resources that we're going to bring into a future period? What's our way in government of recognizing that something has that there's an inflow of resources, but it needs to be related to a future period? Well, fortunately, we have a special spot for that, and they call it a deferred inflow of resources. So we're going to have a deferred inflow of resources for leases, which is basically a way of parking it on the balance sheet. You're going to book a big receivable, and you're going to have this deferred inflow that will be recognized over time. Now, some of you might be thinking, why do I need this credit? I mean, I know my debit is at least receivable. Shouldn't my credit just be taking the asset off my books? And you'd think so, because that's what we did under the old lease standard. But actually, no. The GASB has said, just like the lessee is not putting the actual asset on their books, you should not take the asset off your books at all. So if you're a lessor, the asset stays on your books. So you'll actually have two debits. You have the debit that's already there, the asset you own, and the new debit you stuck on, which is the lease receivable. And we needed a credit to offset it. The deferred inflow is the way that we handle that. Little weird, but we're going to get there. All right, now it's time to take that liability and actually put a dollar amount to it. Well, liability if you're the lessee, or the receivable if you're the lessor. And the way we'll do that is we'll take the present value of all the payments that are expected to be made for the lease term. Now, we have to look at all of the payments. That's going to include any fixed payments. So it's $100 a month for the next 36 months. All right. It also includes variable payments. Those variable payments could be tied to an index or a rate, or you might have a fixed payment that's got a CPI add-on that's built into it, or it could have scheduled rate increases. Basically, what you're going to do is schedule out all the future payments. So if you know that the payments are fixed and won't change, think like a car payment, schedule them all out, fixed, no change. If you know that you're renting a building and it's going to be $100 this year and it's going to go up 3% a year for the next 15 years and you're renting it for 15 years, then schedule out all of your payments with the scheduled rate increases. It doesn't matter if that is a fixed thing, like a fixed 3%, or if it's something that's tied to a rate where, like, the CPI, where the rate can change every year, or it's tied to LIBOR or some other interest rate, then what you're going to do is use whatever that rate is at the time you do the math up front. We're not going to change this going forward. We're going to do a one-time math. So as of today, I know that my rent is $100 a month and it goes up by whatever the CPI is in the future. Well, what's the CPI today? It's not 2%, but let's pretend it's 2%. It's 2%. Great. I'm just going to schedule it out based on today's CPI of 2%, and that's how I'm going to value the lease. Actual results will absolutely vary, and that's okay. We just have to do something to value it as of today, and then we move on. So if you have fixed payments or gradually increasing payments, that's pretty easy. Sometimes you have weird payments, like it's a rent holiday. You're going to lease this and you don't have to pay anything for the first 2 years, and then you pay in the future. Whatever the cash flows are, schedule out all the payments that will be made and then discount them to their net present value. Excel can do most of this for you. And if you have a low volume of leases, that may be the way you want to handle it. If you have more complicated leases or a high volume of leases, there's a lot of companies out there who would love to sell you their software. If you're looking for recommendations, we can have an offline conversation about that. AGA does not specifically recommend any particular vendor, but there are a number of them out there and that could handle that just fine. Personally, I'm an Excel guy and I like to know how the math works. So you would just be scheduling out all your future cash flows and using the net present value calculators in Excel to come down to what the current cost is. Make sure you include anything that's reasonably certain of being paid. So what's a residual value guarantee? Well, you rented a car, you leased a car, I should say. You've leased a car and you guarantee that at the end of the lease, the car will be worth at least a certain dollar amount. Well, how do you do that? Well, you're saying, I think I'm going to drive it harder than they expect. And so in the end, I'm probably going to have some kind of a penalty at the end. I'm going to have to pay extra. So throw the penalty you expect to pay in now. Oh, you leased that vehicle and it only allows 12,000 miles a year and you think you're going to drive it more than that? Put the mileage penalty in now. Oh, even though it's technically non-cancelable, you expect to go ahead and pay a penalty and get out early. I wanted a 3-year lease. They wouldn't give me a 3-year lease, but they did give me a 5-year lease with an early termination penalty. I'm going to terminate it for 3 years. I just know I am. Fine, write it up and include the termination penalty to get your payments in and move on. Any amounts that are reasonably expected to be paid. So that's all it is. It's putting on your crystal ball hat or whatever the acronym is or expression I'm looking for there and say, here's what I think is going to happen. Schedule them all out. Now, when it's time to discount them to figure out what's principal and what's interest, you have to use some kind of a rate. And the most technically correct rate to use, the rate we would like you to use if you have access to it, is the implicit rate charged in the lease. So if you're the lessee, you can look at the lease and see if they tell you you're leasing this at a rate of 4% interest. Great. Now I know what the implicit rate is. They've said it right in the agreement. Maybe they don't say it, but I could buy this thing new for this price and they're charging me this price and I can tell what the rate is just on the difference between what it would cost to buy and what it costs to lease. Or maybe you can't tell, you've asked, you're not getting an answer, there's just no way. In that case, you can use your incremental borrowing rate. Essentially, what would a bank charge you if you went out and financed it through them? Instead of leasing, you did buy. I know we're leasing, we're not buying, but if we were buying, what interest rate could you get to finance it through a bank in that case? And that would be your incremental borrowing rate. Now, if you're the lessor, there's no reason to have to do that because you know exactly what rate you're charging, you know how much the asset's worth, and you know what interest rate you're charging, you just use that. So in a perfect world, use the actual rate actually used in the lease. In an imperfect world, use your incremental borrowing rate. And then what's going to happen in future periods is you're going to recognize an outflow for the amortization of that discount. But what now? Don't worry. All we're saying is every payment you make is partly principal and partly interest. So you took all those future payments, you discounted them, and you said, this is the principal portion. The difference between the principal and the total payment is my interest. All I'm saying is you're going to expense every period in the future a little bit of interest because we discounted it to get the principal. The rest is interest. It's all good. Hopefully that makes sense. Now, there are times when you would remeasure the liability, and that's if the lease term changed. I was leasing it for 5 years. Now I'm leasing it for 10. Well, yeah, that's going to change your liability. We have to look to the new lease term. There were options that moved around, interest rates changed, things like that. But the thing you have to remember is the only time we're going to look at any of those variable components or change any of that math is if something actually triggered a remeasure. In most cases, like the rate change, CPI is different than I estimated. That's fine. We're not going to go back and reopen the lease for every little thing like that changes. Only the big things that change our actual lease term. So we kind of talked through both of those. All right, so pretty straightforward. Remeasuring leases only going to be an issue when something major has changed. Now, what do we book for an asset? The good news is if you did the math for the liability, you're pretty much done. The asset's ready to roll. It's initially measured the same as the liability. So how much am I going to pay? Take all my future payments, whether they're the same or different, stretched out through into the future, discounted to get the principal portion versus the interest portion. And that principal portion, that's my asset. That's the asset I'm going to book. Now, there are a few times we have to tweak it. Like, what if my future payments are lower because I already gave them some cash up front? Well, if you already paid them some cash up front, then you ought to include that in the value of the asset. You paid for it. So it's all your future payments plus whatever you paid up front. Or I'm leasing this, but in addition to what I'm paying my lessor, I'm also having to pay an extra 10 grand to have the thing installed so I can use it properly. Okay, so that's the same as with any capital asset. If you have incurred significant costs to put the asset into service, you capitalize those. You do that today with regular capital assets. So if they're small incremental costs, no big deal. But if they're significant, then you need to capitalize them. Maybe you're leasing your public safety vehicles. So you're leasing cop cars and you're going to lease the car. The lease works out to 36 grand over time. In addition to that, I got to pay 4 grand to put the sirens and the computers and all the other things into it. The cage, the shotgun holder, all the stuff that a cop car needs. I got to pay for all that. Well, capitalize that. You're going to throw that into your lease asset. You're going to pay for it out of cash. It's not part of the lease. It's just because it's additional costs that you've incurred, you're going to add those to the lease asset. Just a place to put them for extra costs that ought to be capitalized. You're going to subtract any cash back if they give you a lease incentive. I'm leasing this vehicle. Here are my future payments. Oh, I get $2,000 cash back right now. Well, that's part of the cash flows, right? When we're discounting what are all the things I'm going to pay in the future, also include any money I'm getting back, any refunds. It's got to be net. That's all that means. So 9 times out of 10, probably 99 times out of 100, your asset and liability will match at inception, but there are a few little things that could throw it off. Now, what do I do with that lease asset? Well, you amortize it. Amortize a lease asset. What does that even mean? Well, that means depreciate, right? The lease asset is essentially like a capital asset. Then the GASB won't let us call it a capital asset. It's a lease asset. We've got capital assets and lease assets. Capital assets are real. Lease assets are these intangible rights to use somebody else's real asset. So I need to amortize it in a systematic and rational manner over the shorter of the lease term or the useful life of the underlying asset. Say again, you need to depreciate it over its useful life. Well, not its full useful life, only the portion of the useful life that you're leasing. So the shorter of those two. So it's a building, it's good for 50 years, but you only have a 3-year lease. You need to depreciate your right to use that building over the 3 years that you're going to use it. It's a piece of equipment and it's only got a 5-year useful life. Hopefully you're not leasing it for more than 5 years, because why would you want to keep paying for something you can't use? But it's a 5-year piece of equipment. You're going to lease it for 5 years, depreciate, amortize over those 5 years. It's basically depreciated over the lease term, unless for some reason the asset's not going to be around that long, but it usually will. The thing that we have to remember when it comes to leases, especially big items like buildings, is we may not be leasing the building for its entire useful life. We may not even be leasing the entire building for its useful life. So this building could be a large building that's going to last 50 years. I'm leasing 1 floor for 5 years. So not the whole building and not the whole useful life. My liability will be comparatively small because I'm only looking at my cash outlays for 5 years for leasing 1 floor of the building. So I'm going to depreciate it over a shorter period than you'd normally expect for a building because I only get to use it for 5 years. So I want to spread my cost over 5 years. Remember, depreciation of capital assets. It's not about their value. It's not about declining value. It's about spreading the cost over the periods that benefit from the asset. If you lease something for 5 years, you get benefits for 5 years. That's how it works. That's the period that we do it. Now, there are a couple of weird little nuances. If you plan to buy the asset at the end, mind you, if it was an automatic transfer of ownership, we're not even having this conversation. It's not a lease. We never even went down the GASB 87 path, move on. But assuming that we are planning to buy it, it wasn't automatic, then we would include that in our future lease payments. I think I will probably buy it, therefore I included it in there. And of course, if we think we're going to buy it, then we're going to have it longer than just the lease term. I'm leasing it for 5 years, but then I expect to buy it at the end. Go ahead and depreciate it over the true useful life to you, not just the lease term in that case. Or if you're leasing land, well, we never depreciate land, right? Well, it depends. Are you leasing the land for 5 years? Then depreciate it over 5 years. That's the period that you get the benefit from. Are you leasing it and then planning to buy it at the end? Then don't depreciate it, because we don't depreciate land that we're going to own. So there's some little nuances, but as a general rule, you're going to depreciate over the period of your lease. Do I ever have to change my asset? Yeah, sure. Anytime you change the liability because there's a change in the contract, change in the term, that sort of thing, just whatever your debit or credit is to the lease liability, do an opposite debit or credit to the lease asset. Pretty much all there is to it. Technically, it's possible, very unlikely, but possible that those adjustments would wipe out your asset. You can't have a negative asset. So if you ever got there, theoretically, you just took a gain from that point forward. It's not going to happen in most real life scenarios. What if the asset you're leasing gets damaged, like GASB 42 impairment kind of damage? Okay, just follow the existing GAAP we have for that. We already have GAAP that says what to do if there's an impairment of a capital asset. Just apply it to these intangible lease assets the same way. If you have to write down the asset, hopefully there will also be some kind of change to your liability to go with it. If there's not, then you just book a loss and move forward. Maybe it's a triple net lease and you're on the hook for whatever the damage is. You got to fix it yourself. Okay, if you have to fix it yourself, then just recognize the loss and move on. Your liability wasn't impacted by that. So what do we do in our governmental funds? I mean, this is all great from a full accrual perspective, but I don't book long-term liabilities. I don't book intangible assets in my general fund. How does that work? Well, there is a little bit of different accounting in your governmental funds. So in your governmental funds, general, special revenue, debt service, capital projects, what you're going to do is you're going to gross up capital outlay expenditures every time you enter into a new lease agreement. So you've gone out and you've entered into a contract, you have leased this asset, we've got this new debt we've got to put on the books. And so what we're going to do is we're going to put the asset on the books and the debt on the books. And the way we're going to do it is in our governmental fund, we're going to gross up capital outlay as if we bought it and other financing sources as if we borrowed it. I know we didn't technically borrow it. There's no cash that changed hands, but the GASB says this is really conceptually not that different than a financed purchase. And so we want the governmental funds to show it that way. You might not be in the habit of doing that today. So that might be the one budgetary impact that you're going to have to give some thought to. You enter into a new lease for a photocopier, you need to gross up debt proceeds for the amount that you essentially borrowed, the non-cancelable payments that you'll be making in the future. So gross up proceeds for that and then gross up capital outlay expenditures as if you made that purchase this year. That's the big change there for governmental funds. Everything else is only going to be in the government line and proprietary fund statements. Now the GASB loves to give us notes. So here's a bunch of notes. I'm going to move fast on these. Basically describe the lease, break down inside the footnotes, the details of the assets. They can be in the same footnote with capital assets, but they have to be broken out. So you can have your list of capital assets where you've got land and building and equipment, and you have leased land and leased building and leased equipment. You can have separate lines for them. If it makes you feel better to have a separate lease asset note entirely, that's also an option. They let you do it either way, but leased assets and purchased assets need to be separated out there. There's just a whole list of other little things that have to be scheduled out, but the big one is going to be your schedule of future minimum payments. Just like other debt, where you show how much is due each of the next 5 years and then 5-year increments after that, you're going to do the same thing for leases. Probably in a separate note, probably leases and debt are going to be separated into separate notes. Certainly they're going to be separate from certain other disclosures. So that's just right now, many of us have a non-cancelable operating lease note already that says these are all the future payments. The only difference now is we're actually going to book the liability. It's otherwise not that different than what we're doing today. All right, let's do our third CPE prompt. Curious what had you signing up for today's training. A bunch of people like the CPE credit. Happy to be able to help with that. And some of you are just longtime subscribers, so to speak. Looks like we're kind of split between those two answers. And there's the others who just kind of wandered in by mistake and not even sure why they're here. We're glad you're here, even if you don't know why. All right, what else do we have in the notes? If you get into the weird stuff, if you're leasing things to other people or sales and leaseback transactions and leaseback transactions, there's note disclosures for all of those. They don't apply to most people, so I'm not going to go into the details now. But if they apply to you, work with your auditors, look into the standard, find the specifics. They're just some basic note disclosures to let people know what's happened. All right, enough theory. Let's get into some practical. let's take a look at the actual debits and credits from this from a real life example. We're going to stick with our theme of leasing a bus. Not the only thing you can lease, obviously, but sure, we'll focus on that. At the beginning of 21, a government enters into a contract for 5 buses. The contract says it's a 5-year term, monthly payments of $2,000 due the last day of each month. And we've even been so kind as the lessor told us it's a 6% borrowing rate. Great, that makes the math easy. We don't have to try to back into it. So I'm leasing 5 buses. It's the monthly payment, $2,000 a month, so $24,000 a year at 6%, 5-year term. More details. After 3 years, I can get out. Oh, so is it a 3-year term or a 5-year term? After the 5th year, I can buy a bus for $12,000. Doesn't automatically transfer it, but I have the option. All right, so more givens. We lease buses all the time, and we almost always keep them for the full term. We just don't get out early. So even though we have the option to terminate, we don't think that's going to happen. And there's really no option for the lessor to terminate early, so that's not going to happen. So we look at our own intent. I don't expect to terminate early. And honestly, even though I have the option to buy the bus, if I wanted to buy it, I would have bought it. I only want to lease it for 5 years and be done. So I don't think I'm going to do that. And there's no automatic transfer. So my question is this a lease? Well, let's look at all the pieces. It has a contract for a tangible asset over a period of time with some kind of a fixed or otherwise known payment. So yeah, we check all the boxes here. This is an exchange or exchange-like transaction to use another entity's tangible asset over a period of time. Yeah, that's a lease. So what's my lease term? Well, I can't terminate for the first 3 years. When I could terminate in years 4 and 5, I think I'm not going to. So ultimately, the term of my lease, if I add up the non-cancelable and the period that I could terminate but choose not to, is going to be 5 years. Great. How about the option to purchase? If I thought I was going to purchase, then yes, I should include it. If I think I'm not going to purchase, then no, I shouldn't. And I said I don't expect to, so we're going to exclude it. So we do our math. We get the buses at the beginning of 21. The first payment is due at the end of the month. The payment schedule is 5 years, which is the same as 60 months. We have a 6% interest rate, and our purchase price, which we expect we are not going to exercise, is irrelevant because we're not going to buy it. Therefore, we can exclude it. So what does that do for us? Well, if you want to do it in lease software, you can load all that in and let the software do its thing. Or maybe even if you use lease software, you want to see it in Excel, at least 1 or 2 to make sure you're comfortable it's doing it right. So what would we do in Excel? Well, the formula you want to use is called PV, present value. The rate we would want is 6% divided by 12 months to get our monthly rate, since there are monthly payments. The number of payments is either 5 years times 12 months or just 60 months, however you want to load that in. The cash payment going out the door is negative $2,000. So we have $2,000 a month going out. That's going to be our cash payment. And the future value, that's how much are we going to get back in some kind of residual? That's 0, because we're going to turn this thing in and have nothing to show for it. And then the last comma 0 there is you can choose either 0 or 1, depending on whether you make your payments on the first day of the month or the last day of the month. It matters just because Excel needs to know which, when it's calculating the interest, is it calculating it from the first day or from the end of the first month? Minor difference, only changes it by a few bucks. So if you key in that formula in Excel equals PV 6% divided by 12, comma 60, comma negative $2,000, comma 00, it's going to give you an answer, $103,451. So we've really got $120,000 of payments that are going out the door. Over the 5 years of our lease, 2021, 2, 3, 4, 5, we're going to pay $2,000 a month, 12 months of the year, it's $24,000. So our payment of $24,000 a month is going out for 5 years. $120,000 is our cash outlay, or will be our cash outlay. How much of that is principal? How much is interest? According to Excel's present value calculation, the principal portion is $103,451, and the interest portion will be $16,549. Over time, just like any other mortgage or other bond, the interest is higher at the beginning and lower at the end as we pay the principal debt. We have a lot of principal outstanding, interest is high. We have a little principal outstanding, interest is low. Over time, principal goes up, interest goes down, total payment stays the same. So our liability is $103,451, and our asset is $103,451. But our asset's going to get depreciated. Well, technically amortized over 5 years on a straight line basis. So I'm going to have the equal amounts of debt and asset show up on my books. 103,451 is both asset and liability. My liability is going to go down 18 grand and then 19 grand and then 20 grand and then 21 grand and then 23 grand, finally get to zero. My asset's going to go down by 21 grand every year and eventually get to zero. And you can see they will match on day one and they will match at the end of 60 months. But in between, my asset and liability are going to get a little out of sync. That's okay. It's normal. It's what happens. So journal entries. In your governmental fund, assuming this happens in the general fund, you would debit capital outlay and credit other financing sources for the proceeds of the lease. $103,000 debit credit done. When it comes time to do your government-wide financials, then we'd have to get the other financing source off the books. So we would debit that to get rid of it. And we have to get the capital outlay off the books. So we'd credit that to get rid of it. And instead we would credit our liability and we'd debit our lease asset. So we have a lease asset, a lease liability broken down between current and long-term portions, and away we go. Now, if you did this in an enterprise fund to start with, basically you can net all these out and get the same answer. Here's the same entry if you were an enterprise fund. Debit the lease asset, credit the lease liability, and then just broke it down between the current and long-term portions. So that's at inception, the initial journal entry to book the lease. Over the course of your first year in a governmental fund, you're going to have payments, right? $24,000 is going to go out of cash over the course of the year, $2 grand a month, every month. That should be broken down between principal and interest. The principal part gets shown as debt service principal. The interest gets shown as debt service interest. Now, I know it's going to happen as a practical matter. Some of you are going to say, well, I already booked $2 grand a month to lease expense and $2 grand a month to cash. So for you, the adjustment from where you are to where you need to be is not to hit cash. It's rather to credit lease expense because you already booked it somewhere that it shouldn't have been. Now I got to move it into principal and interest. No big deal. Same net effect. All we're worried about is where you land. And then on the government wide, you're just going to pay down the current portion of long-term debt and then swap out. Ultimately, we're going to swap out what's the new current portion, and we're going to amortize the asset. Nice even dollar amounts through there. In an enterprise fund, same thing, just netted together. And then, of course, we'd have to move our last little bit for the the portion that's due within 1 year. Now, depending on when your payments fall, this one fell at the beginning of the year or the month, so it was nice and clean, or at the end of the month, rather, it was nice and clean. We didn't have anything to deal with accrued interest. You should look to see if accrued interest is material. Probably it's not a big deal, but if it is, then obviously deal with that. All right, before we go on to year 2, let's take our 4th CPE prompt. This one's simple. Are you still here? Technically, you get credit for answering anything. So if you say that you're not here, you're still here. All right, about 2/3 of you say yes. About 1/3 of you are saying yes with gusto, the absolutelys, and a few of you are like, yeah, I don't know. I may be here, I may not. That's okay. Maybe you're bots just answering for us. What are we going to do in year 2? The entries should look really familiar in year 2. All we're using is the amortization schedule to figure it out. The principal and interest still add up to 24 grand, but now there's a different mix because in year 2, there's a little more principal, a little less interest. Otherwise, the liability goes down by the amount of principal and the amortization of the asset just keeps plugging away. Same thing on the enterprise fund and same thing at the end for the current portion. Really no change. So let's take a look at where we are 2 years in. This is not a journal entry. This is where we're sitting after 2 years of lease. The lease liability is now down to $65,000. It started at $103,000. We've paid off 2 years worth. So now the liability is down to $65,000. And the asset has been amortized. We've got a couple of years of amortization in there. We have a net present value down, or net book value, I should say, of $62,000. So I've got an asset for $62,000, a liability for $65,000. I'm a little upside down. It happens all the time. It happens with all installment purchase agreements. It happens today when you go out and buy an asset. Depreciation is usually straight line, and debt is usually heavier on interest in the early years and lighter in the later years, just kind of how it is. So what should our note look like at the end of year 2? Simple disclosure: government's leasing 5 buses, starting with this date, monthly payments of this amount, interest rate of that. That's all there is to it. Now, if you've got thousands of leases, heck, if you even have dozens of leases, we're going to have to aggregate this, right? Think about your existing long-term debt schedule. You do not necessarily list the details of every single piece of debt. that you have. A few of you do. You have really long notes. If you like that, you want to do it, you can. But some kind of aggregation would be acceptable. You could say I have equipment leases ranging from 5 to 10 years with interest rates of 3 to 6%. You can kind of pull it in. But if we're trying to be really really specific, really technical, this is the kind of disclosure that would be required. All the details, just explaining how the lease works. Where does it show up? In your capital asset note. Assuming you don't want a separate lease asset note, which I told you is an option, assuming you're just going to stick it with capital assets, you're going to have your building and equipment, and then your leased building and your leased equipment, your leased vehicles. Just list them as separate line items. You can even track them in your fixed asset module, like you would with any other asset, as long as they have a way of being segregated as being leased. So as long as your asset module will let you create some different categories to track those, you'll have exactly what you need to be able to make that work. So just include them in there, include your depreciation like you would, and move on. In your lease note, you'll have a schedule of future minimum payments. So I've got 3 years left of my original 5 years. Again, this is just for one lease. You'll have all of these aggregated together for all your leases, just like you do with all your other debt. It should not be mixed with your debt though, right? Lease maturities should be separate from bond maturities and separate from whatever else you have for direct installment and other debt. So future minimum payments, you can see 24 grand a year for the next 3 years, just like we thought. That's all going to be good. All right, so that's kind of where we are. That's how it plays out. Pretty smooth, pretty straightforward. Let me throw one wrinkle at you. What would happen if, in addition to the $2 grand a month, there was there was a quarterly payment of $500? What if there was $500 per quarter to cover maintenance? And that covers oil changes, tune-ups, etc. Should we include that in our lease liability? And the answer is no, because that's a service, right? That's not leasing the asset. That's not the right to use the asset. That is, you've agreed to pay for service in the future. You'll just expense that in the time. All right. So some things, even though they're in the contract, we don't include in the liability because it's really just providing a service. Other things that might be written in the contract, we might. What if we have to pay $50 a month for mileage? Well, if that's fixed, then it's just part of our cash flows, include it. Plus $1 for every mile that we go over 500. Well, the $50 per month, that's just part of our lease payment. Include it in your cash flows and move on. But the portion that's based on future mileage, you don't know how many miles you're going to drive yet. And in that case, that is variable, and you need to exclude that from the liability. So what we're actually going to end up with is our $2,000 a month regular payment plus our $50 a month fixed and substance payment. We are not going to include the mileage. We're going to expense that as we incur it. If you don't like mileage, think photocopier. We're leasing the copier, and we're going to pay a per page charge in addition to our base fee. The per page charge just gets expensed as it incurred. So now instead of 24 grand a month or a year, it's now 24.6 a year. All the math is the same. It's just now it's 106 grand instead of 103 grand when we do the present value. So little things like that. Some things you exclude, like service contracts. Some things you include, like additional fees that are fixed in substance. So how do we get ready for this standard? Well, we're running out of time. It was originally supposed to be implemented by the end of, not last year, the end of more than a year ago, 2020. We got an extra 18 months out of it, which was great. Of course, nobody got 18 months. You either got 1 year or you got 2, depending on what your fiscal year is. And now you need to be ready to move forward. Now, the good news is at the time of implementation, you don't have to go back and figure out what this lease was all about. If you're 5 years into a 10-year lease, who cares about what was happening 5 years ago? Everything is from today forward. So from the first day of the fiscal year of implementation, the beginning of your fiscal year. So if you're implementing for 6/30/2022, it's effective July 1 that you do this math. If you're implementing for 12/31/2022, then it's effective 1/1/22 that you're doing this math. The beginning of the fiscal year that you do this implementation, what are all the future payments that are going to come? So what payments will be made in the future from that point forward? That's your lease. That's your lease liability. That's your lease asset. That's all we're looking at. So for some of them, you might be in the last 2 years of a 20-year lease. Your asset and liability are going to be really small. We're just booking the 2 years that are left. For new leases, we'll book the whole thing. But at the date of implementation, we don't have to worry about anything except what's left. And we don't have to try to figure out what our intent was years ago. The question now is, what is it today at the day of implementation? So that makes it much easier. Now, there is a possibility that you'll have prior period adjustments here because some of these leases might already be on your books as assets and liabilities. We have to take those off and put the lease asset and lease liabilities on. The liability is probably the same. It probably won't change. You'll probably do this math and say, yep, that's the same liability I already have in my books. However, the asset technically is on your books at the wrong amount because you now have to reset the asset to match the liability. That might create a small prior period adjustment. Now, you might argue it's so small you don't even care and you're just going to pass on materiality. That's a separate consideration. But just realize that. Now, if you have an existing capital lease with an automatic transfer of ownership, no change. You just take the lease word out of the name. Don't call it a lease anymore. It's already on your books as capital asset. It's already in your books as long-term debt. You're golden. Just run with it. But if it's a purchase option, that's different. If it's an automatic transfer, then it's not a lease. It's a finance purchase. If it's the option to purchase, now it's a lease, and you're going to have to go through the math this way. So I've said this several times. I'm sure you're sick of hearing me say it. Materiality matters. The 12 most important words of any GASB statement are don't bother with the immaterial items. That means that you're going to have to give some thought to what's material. We do it with assets all the time, right? This is my stapler. This stapler was used when I got it, when I joined the firm, and that was 26 years ago. So this stapler is at least 26 years old. From the looks, I'd be willing to guess it's probably 40 years old. This would be a capital asset of my firm, right? It's an asset used in operation, useful life well in excess of a year. So why is this not on Raymond's books? Because it's a stapler. Nobody cares. I mean, 20, 30 years ago when we bought this thing, what did it cost? 10 bucks? There's a practical point where we say it's too small to matter. We don't need to capitalize immaterial items. Now, that was a silly example. That's only 10 bucks. But what about $1,000? What about $10,000? What about $100,000? Every government's going to set their own threshold. In fact, you all have on your capital assets today. Many of you have a capitalization threshold of $5,000. You'd say, if I was buying a laptop computer, I'm not going to put that on my capital asset records. It's too small. So why would it be any different if you leased that computer? If I was going to buy a copier for $2,000, I wouldn't put it on my books. So why would it be any different if you leased that copier? You need to consider expanding your capitalization threshold to include not just capital assets, but also leased assets and the related lease liabilities. I know it feels weird to leave a liability off your books, right? As accountants, we want to be complete when it comes to debt, but we need to recognize the fact that the asset has to match the liability. They have to move together. And if the asset's immaterial, the liability is too. And if you want to lower that threshold and include them, you can. You're just signing up for more work for yourself. And if you don't, that's okay. Materiality should be a consideration there. Going forward, if you can negotiate your leases in a way that specifies the interest rate, makes it obvious what the period of the lease is, cut down on the amount of work you have to do to try and figure this out in the future, that might make your life easier. If you can't, you can't, but just something to keep in mind. And realize that while this is a lot of work to find all the leases, to figure out what's out there, frankly, these leases are contracts that you're signed up for having to pay every year anyway. It's probably a good idea to know what's out there. You probably should want to know what all your leases are. Even if in the end you decide not to book some of them because they're immaterial, wouldn't you rather have a complete list of all the contractual obligations that you just aren't in a position to cancel? Could be helpful from a budgetary perspective. So moving forward, consider your capitalization policy. Consider that you may be adding new liabilities to your books that haven't been there in the past, and that could throw off debt limitations or bond covenants, or it could even run awry of some sort of grant agreements. I'm not thinking specifically about those might be, but be aware of it, keep an eye on it, and make sure that you're considering all those little nuances. All right, hopefully you have all survived GASB 87, and we can move on to some other things right after we take this CPE prompt. Looking ahead, it looks like the big winner right now are audit and financial reporting type trainings in the future, federal and state compliance, and other big topics. So as always, we will take your considerations and your recommendations under advisement as we develop future training programs. Appreciate your input there. All right, let's talk about a few other standards in our remaining time. GASB 89, I promised, was a super easy one to implement. It gets rid of the option and requirement to capitalize interest during construction periods. It was always a complicated piece of math. It was a challenge. It was done inconsistently because we were only supposed to do it for enterprise funds, not for any other. And the GASBs basically said, yeah, don't do that anymore. That's all there is to it. Stop capitalizing interest prospectively. If you've done it in the past, nothing to fix, nothing to change, just keep it simple going forward. In the future, as you incur interest costs, expense them. No more capitalization, life is good. That's it. One slide, we're done. Conduit debt obligations. Most of you do not have CDOs. A CDO is a very unique situation. This standard will be effective at the end of this year, and it says if you have a true conduit debt obligation, here's some notes we want you to book. What is a conduit debt? Conduit debt is, this is not your liability. You have no contractual obligation whatsoever. So let's break it down. With conduit debt, there's at least three parties involved. There's the issuer, that's going to be the government who's adopting the standard, who issues debt in their name. A third-party obligor, so somebody else who's responsible for repaying the debt, and a debt holder or a trustee, whoever you're borrowing the money from. Now, the issuer and the third-party obligor can't be within the same reporting entity. We've got to be dealing with three completely separate parties. And the debt can't be a parity bond or cross-collateralized, which ultimately undoes that answer. And then the proceeds don't go to the government who issued the debt. They go to the third-party obligor. So we'll just make up an example here. I am a city, and this conduit debt has been issued, and the proceeds go to this for-profit business. I issued the debt as a conduit legally to help things out. It had to be in the city's name, but it's going straight to the ABC company. I didn't even get the money. It was their money. And they, ABC company, are primarily responsible for paying the debt back. It's not my job. I don't have to do anything to repay it. In fact, my only involvement is I have a limited commitment in order to make them be tax exempt. I have no responsibility to make debt service payments other than whatever ABC company pays. If ABC company misses a payment, I don't have to make it up. I am just a conduit for the tax exempt development purposes. Now, there are things that I might choose to do that would screw that up. I might make additional commitments that are beyond what I'm required to do. I might make voluntary commitments that are beyond what I'm required to do. They might be things like a moral obligation. I just feel bad. ABC company went out of business and didn't pay. Maybe I should pay for them. Or an appropriation. I'm going to go ahead and put money out there. I'm going to say right in my budget, if ABC doesn't pay, I will. Or I'm going to make a written guarantee. I will back ABC. They will pay or I'll pay for them. Or I'll set aside some of my own assets. Oh boy. Or on a voluntary basis, when they don't pay, I just choose to pay. If you do any of those things, then you're not really conduit anymore. Now you've agreed to pay. So basically, don't book a liability. If it's a conduit debt, don't book a liability unless you've made one of these additional or voluntary commitments. And honestly, why would you do that? If you make an additional or a voluntary commitment, then every year you have to ask yourself, are they going to pay? And if it's more likely than not that they're not going to pay, then you have to book a liability for what they're going to leave you stuck holding the bag. But true conduit debt, you shouldn't be stuck holding the bag. That's why it's a conduit in the first place. Now, there are some times in connection with these CDOs where ABC company is going to buy something or build something, and technically you own it, but until they pay off the debt, but it's just on paper. And we care more about economic substance than legal form. So in those cases, they're making the payments, they're covering the debt payment coincides with everything. Even though it sounds like it is a lease, it's not. We're not going to call that a lease. We're not going to worry about that at all. Other things that could happen there, if they release title at the end of the arrangement, so you've issued the debt in your name, but you're a conduit, you're not responsible for paying, and at the end of the agreement, then you hand off the asset to ABC. Don't book an asset, don't book debt, don't book a receipt, book nothing. This is nothing. It's just a note disclosure. But if at the end of all this, after ABC is done paying it all off, you actually get the asset, then wait until that happens and book a donation of the asset at that time. Don't book anything in advance. Wait until it actually takes place in the future. And if there is, the issuer gets to keep the title at the end, and the third-party obligor only has use of some of it, then it gets even more complicated. Then you do book the asset, but you don't book the debt. I don't think this is going to come up in practice, so don't get too hung up over that. Note disclosures just describe that the conduit's out there, and if you've made any of these voluntary or additional commitments, describe those as well. So bottom line, most of you don't have conduit debt. Most of you, if you have anything that's close to this, you're actually issuing full faith and credit. So counties do this all the time. Counties will say, I'm going to issue full faith and credit, and even though I expect the township's going to pay me back, I've lent my credit rating as a county to help them out. In that scenario, that's not conduit debt. The county has issued its full faith and credit. It is on the hook, and it should book a liability. Conduit debt is my name's on it, but I don't have to pay it back at all. And in that case, it's note disclosure only. GASB 92 is a catch-all. Lots of little technical corrections. They peppered 4 or 5 different standards with little tiny corrections. There's really nothing I want to highlight or point out to you here other than to say they fixed little things along the way that we've mostly talked about in place where they are. GASB 93 also won't affect most of you, but way back with GASB 53, there was all this special accounting around hedges, effective hedges. Hedge accounting was a way for governments to reduce risk. And sometimes the way they reduce risk is to convert certain variable rate debt to fixed rate debt. And it had to do with interest rate indices. And one of those indices was LIBOR, and LIBOR is supposed to be going away. And so the GASB said, you know what, we need to give you an out for that. So if what I just talked about sounds like complete gibberish to you, okay, this standard's not for you. If you say, gosh, yes, I am currently trying to maintain effective hedge accounting, good news. GASB 93 says if all that happened was LIBOR got swapped out for something comparable, keep doing what you're doing, no change required. So this is a very easy standard to implement. There's a lot of paragraphs, there's a lot of back and forth and math, but at the end of the day, you just keep doing what you're doing, you'll be fine. We're going to spend some time very likely in next year's GAAP update, getting into the weeds of public-private partnerships and APAs. But essentially, next year, we're going to have this new standard that's going to talk about times when one government contracts with an operator to provide some kind of public service by controlling the right to operate or use an asset in an exchange or exchange-like transaction. And it's going to get complicated because it could be a service concession arrangement or it could be a lease. And those kinds of transactions get interesting. Now, this is very different than just hiring a company to do something for you. This is like where you completely turn over the rights to operate an asset and you kind of have given up the control to somebody else. Often there's a big upfront cash payment involved. We see it sometimes in universities with dorms. We see it sometimes with states and highway systems. You might see it with a community and an arena or some other kind of public facility. But usually it's a large amount of cash upfront for somebody else to kind of take over and do things. Because it's fairly rare and because it's more than a year out, I'm not going to take the time to go into the in depth on this, but just understand that these PPPs can get into some interesting accounting, and we'll talk more about it in the future. Similar to PPPs are these APAs, and that's where government compensates an operator to include designing, constructing, maintaining, or operating a facility for a period of time. And in that case, the maintaining and operating costs get expensed, and the designing and constructing costs get like a financed purchase. And the math isn't terribly complicated. It's just, I guess, in the real world, the GASB was getting a lot of questions about people with weird transactions, and they said, we need to give you something to follow. The good news is all the somethings that you can follow are mirrored on other parts of GAAP. So we just have to ask ourselves, is this more like a lease? Is it more like a purchase? Is it more like something that should be expensed as it occurred? And we'll get to the right answer. So not too bad with any of those, but just so you know, they're out there. All right, CPE prompt number 6. We've covered a lot of topics. We still have a few more to cover, but ask how you're feeling about things so far. Few of you already knew much of what we discussed, and that's fair because we have been talking about a few of these for the last couple of years. At least about 83% of you picked up something new so far, so that's good, and we're not done. Let's keep moving ahead. I told you that when the GASB wrote 87, they first scoped out software, and now they've said it's time to come back and take a look at software. We're going to scope it back in, and the way they've done that is with GASB 96. Now, I'm not trying to twist your arm, but GASB 87 implementation is going to be a little bit of a shock to the system to get everybody used to it. And then what's going to happen is a year later, you're going to have to implement GASB 96. Or you could just implement them together because they're basically the same standard. That's the good news. GASB 96 is basically GASB 87 with a little bit of existing GAAP that's already on the books from GASB 51 thrown in for good measure. Instead of calling it a lease asset and a lease liability, you're going to do everything we already talked about. We're going to call them subscription assets and subscription liabilities, because technically we don't lease software, we subscribe to it. So you've got this cloud software, you've got this software arrangement, this licensing agreement. I guess we could call it licensing assets and licensing liabilities, but they went with subscription asset and subscription liabilities. So this standard's technically not applicable till next summer, but it might not be a bad idea to throw it in. So a subscription-based information technology arrangement, or SBITA, or SPITA. I know it's a terrible, terrible acronym, SPITA. A SPITA might be as simple as off-the-shelf software. So I've signed up for a 3-year subscription to this software. I'm going to pay $100,000 a year for 3 years. That's my subscription. I just need to discount that to its net present value, call it principal and interest, move on. Easy. Sometimes, however, there are additional costs that come along for the ride. Now, these stages that are listed here, the preliminary project stage, the initial implementation stage, and the operational and additional implementation stage, these are borrowed from GASB 51. This is the existing GAAP for intangible assets with computer software, because a lot of times software is more expensive than just what you buy off the shelf. There's all the extra costs you put into it. So what the GASB has said is we're going to apply GASB 51 logic to GASB 87 lease logic. And in the end, we get GASB 96, which tells you what to do with your software. So when you're going out to get new computer software, these are the things you should just expense as you incur them. If you're out there evaluating alternatives, if you're picking a vendor, all the costs that go into deciding what you might do, expense that. Once the software is up and running and you're actually using it, you're paying maintenance costs, you're paying for ongoing operations, expense it. If you're paying maybe an outside party to come in and train your people, expense it. All of that is expensed. The only thing that's going to get shown as a subscription are going to be the actual cost of the software itself and any incremental costs that you incur during the implementation stage. Think of this middle category as kind of the equivalent to the cost of taking an asset and placing it into service. Remember, with a tangible asset, I said you'll have, the asset equals the liability unless you pay something extra to get it ready to use. Like you're leasing a car, but you paid extra to put the lights and sirens and the cage in it. Well, you're leasing the software, you're subscribing to the SPITA. I know. You're subscribing to the subscription-based IT arrangement, but you also incurred some costs to get the software ready. And whatever those costs are to place the subscription asset into service, maybe that's data transfer, maybe that's hiring a third party to do some customization to the software, those costs can be capitalized in addition to whatever you're paying as part of your base subscription. Of course, some of your base subscription might include operations and maintenance, and that's where you have to try to separate that out if possible. But just like a lease, if it's completely baked in and there's no way to separate tech support from the software, then you can just call the whole thing a SPITA, in this case, like a lease. You don't have to split them out. If you can split them out, if the invoice says you're paying 100 grand a year for the software plus 20 grand a year for tech support, then expense the tech support and capitalize through the lease process, the subscription process, the payment. If they're combined and it's just so integrated you can't tell them apart, I'm leasing for 100 grand a year and it comes with free support, then fine, it's all a lease and it's all a subscription, a SPITA, and move on. So the only costs on top of the subscription that you include are the costs for placing it into service. Very similar to what you would do with a tangible capital asset. Not a big difference that you want to work with there. So I think that's going to be relatively simple for most of us. I don't think we're going to struggle too bad with that. So what goes in the notes? General description of our software-based IT arrangements, how much we have outstanding in assets, and the related amortization. So just like you've got lease assets on your capitalization or your capital asset schedule, now we're going to have subscription assets and subscription liabilities that are going to show up in that capital asset schedule. Again, you have the option of separating them out if you want, but I can't think of any reason not to just throw the computer software as in one more line on your capital asset schedule. You have future minimum payments that are going to have to be shown out to maturity. So you do that for your debt, you do that for your leases, now you do that for your subscriptions. We're just going to show future minimum subscription payments. And this last statement, this is also true of leases. I'm not sure if I had it on a slide. They're technically not considered debt under GASB 88. What does that mean? Well, it's not that they're not liabilities. They are liabilities. But GASB 88, which didn't make our cut this year because it was implemented more than a year ago, GASB 88 told us to separate out debt between direct financing and direct placements and other. So basically your general obligation bonds that were competitively bid out in the open market versus your direct placement debt, things like installment purchase notes directly with the bank, that sort of thing. Those get separated out in that debt note. So it just makes sense that we're going to have a debt note that picks up bonds and notes and compensated absences and those kinds of things. And then we're going to have a lease note that shows future lease payments. Then we're going to have a subscription note that shows future subscription payments. Technically, you could throw them all in one big numbered note. That's fine, but you do need to have separate tables for all the different types. So you're going to have a table of future minimum payments for each type of debt and for leases and for subscriptions. So however you want to organize that, the GASB's given us a little bit of breathing room to decide the specifics, but just don't bundle it with debt. Make sure it's broken out separately. So GASB 96, basically just leases for software, not a major change. I do want to go back. I see we had a question that I missed answering earlier. This applies to the lease standard. And here's the question. If we were to lease 20 printers for $24,000 total per year for 2 years, would we look at this lease in total, or would we look at the cost to lease each individual asset? Similar to capital assets, if we bought 20 printers at $1,000 a piece, even though the total expenditure is 20 grand, we probably wouldn't have capitalized it because individually they didn't meet our threshold. Would leases be treated the same way? Now, I want to point out that one of the things the GASB clarified recently, and this was an actual change to existing GAAP, is that when it comes time to looking at capitalization thresholds, governments do need to consider whether the total is material in the aggregate. And so what they're trying to get away from is a situation where a government would have a massively expensive undertaking. And this is really focused on capital assets, but the logic applies to leases and it applies to software and everything else, where we say, I replaced every computer in the government. They were all, under 2 grand a pop. They weren't terribly expensive computers, but collectively, I spent millions of dollars on this. Is it really appropriate to exclude all of that and argue it's immaterial? Is millions of dollars immaterial to your government? Now, to some governments it might be, but probably not. And so the GASB's asked us to please apply that logic when considering capital asset additions. Now, it's absolutely true that the federal cost principles and the GFOA's best practices both recommend a per unit capitalization policy. And so you have to give some thought and say, when I take into account everything my government has on its books, all of the things that we might spend money on, what's really going to give us a material slice of our capital assets? If you've got tens of millions of dollars of infrastructure on your books, excluding a few $1,000s of equipment, it's probably not the end of the world. But if you don't have infrastructure, then maybe those computer equipment do need to be considered. This is a very subjective judgment call. A good rule of thumb, and it's just a rule of thumb, it's not a hard and fast rule, but a good rule of thumb would be try to capture about 80% of the value of your capital assets. If your threshold is excluding more than 20% of the total cost of all the assets that you theoretically would pick up if you were not worrying about materiality, then maybe your threshold's too high. A lot of governments will set separate thresholds for different types. They might say for equipment, we're going to capitalize anything that's over 10 grand, but for building improvements, we're only going to capitalize things that are over 100 grand. And for infrastructure, we're only going to capitalize projects that are over 500 grand. And that's a judgment call, again, you can make depending on different asset classes. You might have a different capitalization threshold for your water and sewer funds that are all infrastructure than you have for your equipment revolving fund, which is all vehicles. All of that's fine. Talk with your auditors, make sure that you get their buy-in, that they're not going to be concerned from a materiality perspective. But at the end of the day, it's a subjective decision. The GASB just wants us to make sure we're considering and not blanket excluding things. Classic example would be a library spends millions of dollars every year buying materials, media for the library, but all of the items are 20, 30 bucks a pop. They would never capitalize anything if they applied this per unit capitalization threshold. So this is fairly new. The GASB recently pushed for this change in focus, and it's something that people are going to have to kind of get used to. But that would be my answer to the threshold there. There is another question that's been posted asking about an ERP based on Oracle Cloud, which is based on a subscription. Would that be applicable? Absolutely. That's exactly the kind of thing that we're looking for here. Subscriptions of software where you have entered into a contract. Follow the GASB 87 math. Is this a non-cancelable contract? Have you entered into an agreement that you have little or no discretion to avoid? If so, take the net present value of the payments during that non-cancelable period, plus any extension periods that are likely to be done. All right, let's talk about GASB 97, because this was trying to fix some problems with GASB 14 on component units and GASB 84 for fiduciary. You'll recall that GASB 84 established some new rules for fiduciary component units. And historically, we've not really worried about fiduciary funds being considered legally separate, because all that mattered was if you're a fiduciary fund, you get reported as a fiduciary fund. We don't care if it's legally separate or not. Well, this new standard fixes some interesting loopholes that were created there. Because what the GASB had said is what to do if you don't have a governing body. How do you determine if you're a component unit? Well, you look to the governing body. Well, what do you do if you don't have a governing body? What the GASB had said was if the primary government by default serves as the governing body for an entity, then just treat them as if the primary government appointed a voting majority. Use that math for determining component units. There's no board, then you might as well say that you appointed the board. The problem was that was going to scope in as fiduciary component units a bunch of things that we've had off the books for years and wanted to stay off the books. Governments frequently have defined contribution plans where all of the investment decisions are made by the employees. Think like a 401k plan. Think a 403b, a 401a, a non-contributory 457 plan. All these plans where the government's only obligation is to make a matching contribution, and once the money's out of their hands, it's really up to the employees to decide how they want to invest it. They have a portal, they can pick their mix of investments and everything else. The GASB's change was actually going to scope all of those onto government's books and make a mess. They're hard to audit. The government really doesn't do anything with that information during the year, and so this standard fixes it. The way this fixed it was it said, if the primary government functions as the board, then treat it as if they have a voting majority, unless it's a defined contribution plan or a non-contributory 457 plan. That change prevented most of those plans from being scoped in. So the other thing it did is GASB 84 said that we have to look at the financial benefit and burden criteria to decide if a defined benefit plan is going to be a component unit. And we said, if the government's on the hook for making pension contributions, so we have an actuary, the actuary says how much has to be contributed. If the government's on the hook for making those payments, then that's a financial benefit or burden that will make them a component unit. Well, what they have now clarified is that criteria for financial benefit and burden only applies to defined benefit plans, not to defined contribution plans. So yes, technically the government does have a financial obligation to match 3% or whatever it is of employee contributions to the plan, but it doesn't trigger component unit reporting unless it's a DB plan. Okay, so that got rid of most of our 403B, 401A plans. Now, what about 457 plans? This is where it gets a little sticky. Historically, if you go far enough back, 457 plans were completely non-contributory. In fact, that meant the local government didn't put any money in. It was just a voluntary withholding by the employee. There was no cost, no obligation. The government was off the hook. But more recently, we've seen more and more governments start to make an employer match on a 457 plan. Now, here's the trick you need to be aware of. The normal rule would be 457 plans don't meet the definition of fiduciary component units, don't have to be booked, don't have to be worried about, it's all good. However, as soon as you start to meet the definition of a pension, meaning that there is some obligation for the employer to make some kind of, to meet some sort of obligation, some kind of defined benefit, then you have to follow all of GASB 67, 68. You need an actuarial valuation, and you have to book the liability and all that fun stuff that goes with it. I'm not going to go into the weeds of that because that's existing GAAP, but just realize 457 plans, if there is an employer obligation to make a contribution and that contribution meets the definition of a DB pension, then you could have these things getting scoped in. Now's a good time to look at your plans, make sure that didn't get missed. Most 457 plans will not be picked up. A few of them might, and it will all come down to that decision. The new standard that is super easy to implement, GASB 98. GASB 98 has renamed the Comprehensive Annual Financial Report to the Annual Comprehensive Financial Report. The new acronym ACFR, which I have it in writing from the GASB, will be pronounced ACFR. The community was all kind of waiting to see, was this going to be the ACFR? Was it going to be the ACFR? How are we going to pronounce it? The GASB chair issued something in writing using that pronunciation guide, ACFR. Okay, that's what we're going to call it. The reason for the change is the old acronym that we used to use when pronounced out loud, and everybody pronounced it out loud, had the exact same pronunciation, different spelling, but the exact same pronunciation of a very offensive ethnic slur from South Africa. And as the governmental accounting community has become more and more global, as the American terminology has worked its way other places, this was brought to the attention of the GFOA, the GASB, and others, and they said, you know what, we need to do whatever we can to avoid essentially using the South African equivalent of what we think of as the N-word. And so this got changed to avoid that. It'll take us some time to get used to it. People are going to slip. I'm probably going to slip and use the old acronym, but we're all going to try our best. And when you hear people referring to the ACFR, if you hear somebody slip and use the old acronym, just refer to it by the ACFR going forward. This is now effective for all fiscal years ending 12/15/21 and later. And we'll just work together to get used to calling it the ACFR in the future. The GASB issues, I say annually, it's been annually, it may not be annually going forward. They may decide which years they don't need it, but implementation guidance. And this is level B GAAP. These are, they go through due process. They do get looked at. They're written by the staff. They're in a Q&A format, but it is level B GAAP. So it is still technically authoritative. There were 23 new questions that were issued in 2021. They talk about the terminology around derivative instruments. They were still clarifying some of the math for GASB 84 and fiduciary activities. They're still coming up with some specific questions on how to implement lease standards and what do I do with non-exchange transactions. None of this is new GAAP. This is all established things that we've done in the past, but it's important to know that they're out there. There were 4 small technical corrections issued to old questions, nothing fundamental that would be real important to let you know. Although I would say that this is how the change to capitalization thresholds came about, was through one of these implementation guides. So do keep an eye on those in the future to make sure you're aware of them. All right, moving forward. Well, we did have a question. Are we expecting an implementation guide for GASB 96? I don't know. The GASB doesn't always announce in advance. It usually has to do with what questions come in. So the GASB is a great website for asking questions. You can log onto their website, click for technical inquiries, and if they get the same question several times in a row, it will typically work its way into an implementation guide. If they have a handful of questions, they'll stick it in a general implementation guide. If they have a ton of questions, they'll issue a dedicated implementation guide just for that standard. But either way, if you have questions, I would encourage you to post them. The GASB will almost never respond to you in writing, but they are great about picking up the phone frequently within a business day of your inquiry. I've never had it take more than a week, and usually 1 or 2 business days. You're on the phone with somebody who understands the technical material, is ready to ask follow-up questions and give you a good answer that you need. Now, if you're in the middle of a debate with somebody over what the answer should be, try and get everybody on the phone so you can all hear and get the right fact pattern, but otherwise it's a great system. All right, what's coming down the pike? We are coming up on our 100 minutes here. I want to get these last few slides out to you before we run out of time. Compensated absences was actually originally supposed to be published at the end of 2021. That's been pushed to the second quarter of this year. And it's intended to give us a little more consistency around the way we book the liability around sick and vacation time. Historically, we have said governments should only book sick and vacation time to the extent that they will be paid out when someone leaves, not to the extent that they could be used as sick and vacation time. Based on the exposure draft, that may be changing. We may actually have to book a liability for the amount that's available for use, not just the amount that's available for payout. When the final standard comes out, I'm sure we'll have some additional training on that, and you'll have a little time before implementation is due, but that may change some of our long-term liabilities. The GASB is working on a new concept statement that should be published at the end of the second quarter of this year on disclosures. Basically, this would be the set of rules, not giving us any new notes now, but the set of rules the GASB would follow when deciding in the future what belongs in the notes and what doesn't. Many people have pointed out that the notes to the financial statements read a little something like a phone book, and the GASB has heard that, taken it under advisement, and is considering what should be in future standards. Are there things we can get rid of? Are there things that simply don't rise to the level of needing to be a note disclosure? We'll see when they come out with that concept statement in the next few months. There will be another omnibus of just minor technical corrections that's coming. Keep your eyes out for that. The GASB recognizes that prior period adjustments, that is restatements, usually corrections of errors, do occur. Ideally, anytime equity changes, it ought to be through the income statement, through current period changes, but mistakes happen, and there are times when we need to have PPAs, and so the GASB is issuing a standard to address that. We saw an exposure draft last year, and the final standard should be out this year. And then one of the first standards that will come out under this new conceptual framework for what belongs in the notes will be the notes about risks and uncertainties. We've all seen COVID-19 footnotes in our financial statements recently, saying there's a lot going on and we're not sure what the impact's going to be. And you kind of scratch your head and say, well, did that tell me anything useful? The GASB is going to give us a little more clarity on what should we disclose in the future when things come up that are uncertain or there are risks. Looking even further down the line, the financial reporting model is coming in 2023. The conceptual framework for recognition is coming in 2023. A new standard on going concern is just going to begin this thought process at the end of 2023. Final standard much further out than that. That's going to be what to do when it looks like a government might not have the wherewithal to stay in business without restructuring. So that'll be interesting. And then the classification of non-financial assets and ultimately how we recognize revenues and expenses are even further down. So we've got a ways, but there's a lot on the GASB's plate. I'm pleased that since Joel took over as the new chair of the GASB, it feels like they're moving a little more deliberately, a little less rushing into things and taking their time. That's helpful for all of us who need a little breathing room, and hopefully it helps them make some better decisions with those standards. We do have one question that came in that I'm going to address. If you have any others, you can get those in the next couple of seconds. That'd be great. Going back to software licenses, the question reads, how are we supposed to be accounting for renewing license year over year? Currently, we have one software program. We buy licenses that are good for a year, and we would capitalize it if it's over the threshold. But next year, if we renew, we just expense. And if we buy additional licenses, we capitalize the new ones if they're over our threshold. Just like leases, you're going to look at the non-cancelable period. And if that non-cancelable period is less than a year, it's considered a short-term subscription, and you expense it every year. There's nothing to capitalize in that case because you don't actually own the software. You subscribe to it for a year, so your useful life is a year. Now, the costs for placing it into service could be spread over a longer period. If this is a rolling, year to year kind of subscription, then that's probably not going to get booked. If it's a 1 year with the option to extend and that's kind of written in, then you're going to go through that same math you would for a lease, and maybe you would have a multiple year that you would end up booking and having a larger asset that could be spread. The thing to realize with much of this, though, is the software changes so much. You're entering into short-term agreements. You don't have to worry about capitalizing it because every year you're expensing something new for that year's subscription. It's new software. You're not really expecting this software to be good for 5 years. You're expecting this software to get you this year. And next year you'll sign a 1-year agreement for the new version of the software because they upgrade it every year. So there's a lot of nuances there, but I wouldn't get too worried about doing the math and saying, it looks like this is really a short-term subscription. That may be correct. That may be the right answer for you, and that's okay. All right, you guys have been great. I'm going to turn things back to our moderator to close us out.
Thank you very much, Stephen. This concludes today's program. Thank you so much for joining us. If you'd like to learn more, please visit Raymond's website at www.raymond.com/government resources. You can also email us at publicsector@raymond.com. Thank you so much and have a great rest of the day.